Hi, I'm Professor Jay Zagorsky, and today we're going to talk about adjusting prices for the effects of inflation. This is based on Chapter 7 of my textbook. The chapter is called Using Prices, which doesn't seem very interesting, maybe even a little boring. But when you adjust prices for the impact of inflation, you reveal hidden economic patterns. In the next few minutes, I'm going to show you 3 of these patterns, and the results might even surprise you. The main idea behind adjusting prices for inflation is that it allows us to compare prices from one time period to another. Otherwise, it's like comparing apples to oranges. But before we begin, you need to understand 2 definitions, real and nominal. Nominal is the actual price, the sticker price for goods and services. Real means adjusted for inflation. Inflation isn't a topic that only professors think about. Instead, it affects you in your personal and business life. Let's talk about 3 examples. The first, investing in the stock market. The second, wages over time. And the third, the price of going to a private college. There's a huge fable that explains why so many people are attracted to investing in the stock market. And the fable is that long-term investors always make lots and lots of money. Where a long-term investor are people willing to invest for 5 or maybe 10 years. Here's the nominal or actual graph of the Dow Jones Industrial Average's first 100 years. The Dow is comprised of just 30 stocks, but its performance tracks the overall stock market. Looking at the graph, the fable appears true. Stock market prices have steadily gone up with only short drops. But here's the secret. Shh. Because the graph is unadjusted for inflation, it's actually telling us a lie. To see the true graph, we need to adjust for the changes in prices over time. Let's look at the real graph. We now see huge peaks and valleys. For example, if you invested in the late 1920s, just before the Great Depression, you wouldn't make your money back until the mid-1950s, roughly 25 years later. That's a much longer time period than what most people consider for a long-term investment. The second example are wages. Let's assume your boss just gave you a raise. Congratulations! That's great news. But after that raise, did your standard of living improve a lot or only a little? I don't know how much you're paid, but I do know how much entry-level workers in the United States make, and that's tracked by the U.S. federal minimum wage in this graph. Historically, the minimum wage has been increasing in a staircase pattern, as we see on this first nominal graph. However, the only way for us to truly determine if minimum wage workers have improved their standard of living is to adjust for inflation. Wow! The graph done in real terms looks incredibly different. Up to the mid-1960s, the overall trend is rising. Since the 1960s, however, the trend is falling, resulting in less purchasing power for people in entryway jobs such as flipping hamburgers. Our third example is tuition. Many students and parents are concerned about rising tuition at U.S. colleges. Let's look at a graph that shows tuition, room and board at private colleges since the early 1960s. Judging by this graph, the price of going to a private college increased by a factor of 40 since the early 1960s. Based on the last 2 examples, you might be hoping for a fall in real prices. So let's look at the adjusted graph. Unfortunately, it too shows a steady increase in price. The adjusted picture reveals if you're enrolled at a private college, you're actually paying 3 times as much, but not 40, as so in the 1960s for the same degree. In conclusion, there's 2 big ideas from this video. First, you have to adjust for the effects of inflation. It's essential for understanding what's going on in the world. Second, even when prices are rising over time, you can't predict ahead of time what the inflation-adjusted or real graph will look like. And the last 3 examples all had very unique patterns. How do you adjust for the effects of inflation? That's what we'll cover in the next 2 videos. Thanks for watching. See you next time.